All right, welcome back, JP Morgan. In play this morning, pretty decent pre-market volume, but we're going to start out with the spiders here. Clearly, you can see we just keep bouncing around. Most traders have been extraordinarily frustrated with trading the market in general. You'll make your bigger money when you have intraday trend days and when the trend days are in the same direction of an obvious move. And right now, we're just really not seeing that. You can see that clearly the 20 and the 50, and I'll just reiterate it again. I'm using an exponential 20, but a simple 50 on the daily. We're not really seeing trend days in the direction of a higher time frame institutional bias. And essentially what that means is buyers are clearly in charge for a longer term picture. However, the shorter term has been choppy at best. You can see here clearly going back to, let's call the beginning of February here, maybe 1, 2, 3, 4 trend days for the entire month of February going into March. We had 1, 2, 3, maybe if you count this one at the end of the month. So bullish trend days in the direction of longer term institutional order flow has been sparse, which essentially also translates into minimum excellent opportunities on the long side with the market being behind your picture, as well as something that's probably not talked about enough is the pullbacks are opportunities to look to buy. And when you're getting pullbacks that are perceived as good levels to buy, but you're not getting follow through. As a matter of fact, you're getting trend days to the downside. It's turning into some ugly trading where you're doing what you're supposed to do, but you're losing money. So the better traders right now are those that are not sizing up until this shorter term consolidation in the SPY works itself out. And you can see here just simple technical analysis. We drew this line a few days ago in this area here. We pushed up, came back in. That's a pretty telling sign. In my vernacular, if you've ever taken my course, I call that a bearish U-turn, where it actually trades higher, pushes back, and comes back in. And you can see, let me just zoom in here to the 15-minute chart to show you what that looks like intraday. One of my favorite trades is what I term a saturation play, which is also a tailored trading technique from years ago, where you have a really solid bullish day followed by another one. The third day, it's very hard more often than not for it to follow through. So what I usually do is look at some area above as a significant reference point to look for a short. And we actually got a nice push right out of the gate. And we had 1, 2, 3 indecision candles on the 15-minute charts. We had 45 minutes of indecision after. See, this is the key here, though. After 2 significant days. This by itself doesn't mean as much with this. So we had price exhaustion leading into 45 minutes of indecision, and we ended up pulling back on that about $1.50. So setting up the daily charts to create intraday opportunities is massively important. So we're going to zoom out now and go into JP Morgan. As I said previously, the 63 level, actually, you know what, I want to zoom out on this just a little bit here for a significant reason. Now, normally somebody would draw a line and you'd be like, well, you know, you're going to draw it up here because that's where it went to. However, you have to take yourself out of pure technical analysis. You know, the ways that I describe it, in my opinion, one of the easiest ways for people to understand is you want to talk about it in the context of where is price action actually traveling and what's happening at that level. So at this level here, this high, which is 61.48, so let's just call it 61.50. Price pushed up there, next day it couldn't get through there. Pushed up there again a month later, next day it couldn't get through there again. Pushed up here, couldn't get through. So do you see how, like, yeah, it would be very easy for me to, yep, that's the level. However, this was the level until it pushed through, and then what happened at that level? It immediately got slapped right back down again. Next day we tried to get through there again. Next day we got through there, indecision, and slapped again. Got up there again, resistance, pushed through, came back in again. And now we're kind of just trading above there a little bit pre-market. I don't know if you trade pre-market or not, but the point is you need to know the levels that price action actually can or can't hold. So yes, this is technically breaking pure technical analysis by not having it up here. However, that's the real price. That's the price that we're watching. So right now we're trading at 63.05 in that area pre-market right now. But 150 is the real number. If we push through there, pull back in intraday, if we can't hold it intraday and pull back in, there's going to be a lot of people caught on the wrong side, and that could accelerate move to the downside. If it happens, we're laying out if-then scenarios. If it stays above that level, pre-market pulls back on the open at 9:30 and holds the 6150 level, that's significant. So that's really the two pre-market levels that you're going to be watching now. Actually, one is weekly chart level, the other one is pre-market level to know where you are now. So we're essentially trading between 6150 and 63 on the breakout. As of right now, that's a tight range to have as a significant reference point for JP Morgan right now. That's the real range. If you're really trading the stock and looking for the levels that institutions have done something significantly, you must be paying attention to JP Morgan at those levels.